Our market monitor tonight is recommending Apple to his clients, along with some other names that you may recognize. He is Mark Luschini. He's the Chief Investment Strategist over at Janney Montgomery Scott. Mark, welcome. Nice to have you here. So,
thanks, Sue.
What do you think about Apple going into the Dow and what effect it might or might not have?
Well, we saw today it acted actually pretty well in light of a market that was down about 1.5%. So it's getting some short-term boost from that. There is, Dom said, a few ETFs that are proxy to the Dow Jones Industrial Average that are going to have to buy the stock now that's being entered into the Dow. And so as a consequence, that'll help short-term. I think longer term, though, I wouldn't buy it or not buy it predicated upon its being a part of the Dow Jones Industrial Average. At the end of the day, I'd want to own it for the stock's own merit, the company's own merit, and for that reason, we do own it. We think that they are doing a lot of good things in terms of the product cycle they're in the midst of and what they expect to be launching here shortly. Read the watch, that is, and possibly other products, including a car out toward the end of the decade. So, the cash flow rich company paying a decent dividend that will likely increase. There's a lot of other good reasons why we think you want to own Apple stock as opposed to it just being a member of the Dow Jones Industrial Average.
You're not concerned. Apple can be a slightly lumpy company in terms of its earnings, and boy, there have been some very lovely lumps lately. But that the boost that it got from the iPhone 6 is relatively going to fade over time.
Well, I don't disagree with you, Tyler. I mean, obviously, they did get a big boost from the 6. They're going to be coming out with, likely in the second half of this year, a larger iPad to try to reflate activity surrounding sales of the iPad, which has recently started to decelerate. And of course, the watch is going to be a splash. It's obviously still open-ended as to how successful that product is going to be. But at the end of the day, the merits of the company in terms of a valuation of just 15 times, the fact that it generates about $16 billion of free cash flow on a quarterly basis, has about $150 billion of cash on its books, all together says that you can afford a little lumpiness in earnings. It's a good quality company that still has growth ahead of it.
You also like McDonald's, and I assume that you think that the new CEO is going to right the ship.
We do, Sue. I mean, with that, in lies, we think the opportunity in the stock, a chance to maybe remake the menu, make it a little bit cleaner, and as well attract an audience, namely the millennials, who have drifted away from McDonald's because they perceive it to be not the highest quality food product relative to other options like Chipotle and so on. And so as a consequence, we think there's a chance for a new CEO to step in and make some immediate progress. And in the meantime, for investors, today, with where it closed, it yields 3.5%, which is a very attractive coupon in this interest rate environment.
Give us 30 seconds on your third choice, Citigroup.
Well, Citi, of course, is a much maligned institution, failed the last go-around to stress test. This time it passed. Next Wednesday, we'll know whether it can actually begin to reallocate some of its abundance of capital back to shareholders, either in the form of buybacks or raising its dividend, which is just a token amount at this juncture. It's one of the most cheaply valued money center banks in the market today. We think it is attractive and a great value can be unlocked in the share price.
All right, Mark, thank you so much for joining us. Have a great weekend.
Thank you, Sue.
Mark Luschini with Janney Montgomery Scott.